I think it's a little bit disappointing. Inflation's falling, that's good news, but it's not falling as quickly as people would hope, certainly the Bank of England, and that's true at the headline level and at the core level. The bank would take a little bit of comfort from the fact that core services inflation is falling. And I think the Bank of England in particular are very conscious that we're yet to see the lagged impact of the monetary tightening that's already happened. So that should come through over the next few months. I think, once again, today's numbers really all about the very volatile food sector. And that I think food inflation will fall quite rapidly over the next few months. If you look at core producer prices, factory gate prices, commodity prices, shipping costs, all those things imply that food inflation should fall quite sharply over the next few months, and maybe that will lead to a much better number in April. So
what's keeping that food price inflation sticky at the top? And if we say sticky, actually a little bit really high, 19.1% compared to the 18% that we had in that February data. It's really hitting hard.
Yeah, well, I think the UK is a major importer of food, of course. I think some of it is a reaction to sterling's been weak up until the last few months. Sterling's been weak for the last year or two, so that's a factor. And then it's all sorts of food shortages caused by shortages of food across Europe and Africa, poor harvest and things such as that. But the UK is a major importer. But I think the Bank of England won't be too concerned about that. Of course they will, in the sense that it hurts the everyday consumer. Sure. But they will expect food prices, the indicators are saying that food prices are going to drop quite sharply over the next few months. So that would be a factor in their deliberations when they come to sit down in May.
Have we seen all of the energy price drop off in these numbers? I mean, wholesale gas prices are now at levels that we hadn't seen even before the war in Ukraine. Have we gotten to a point where we've seen the worst of those numbers, and now that drop-off is fully sort of priced into the inflation number, for example?
I think we've seen the most of it. I don't think we've seen all of it yet. I think there's more to come through in the April numbers. We'll see another big drop in fuel prices, I think, coming through in April. So some of the forecasts I'm seeing in April suggest that CPI might be down as low as 8 to 8.5. It's quite a big drop, and a lot of that will come from the energy space and maybe food as well. So I think there's a little bit more to come through from energy as well. But I think the Bank of England they will take some comfort for some of the underlying trends, and more importantly, they'll also need to factor in the fact there's lagged impact of monetary tightening, the fact that we don't yet know whether there's more to come from the credit crunch as a result of some of the banking problems. They'll factor in the fact that consumption's likely to fall from here on in as the economy goes in maybe into a mild recession. So a lot for the bank to think about.
Yes, you speak about that mild recession. Sterling stronger a little bit today as well. My colleagues were saying around 0.25% as well, better off than today. You have growth, yes, slightly better, meaning milder recession. But overall, the Bank of England now, seemingly, the estimates are that you may actually definitely get a hike of around 25 basis points. Would they have preferred to keep things as they are right now at that 4.25%?
I think they probably would, but at the end of the day, it's a bit of a double-edged sword for them, because I think they want to see inflation down, clearly, but I think they themselves expect it to come down quite sharply, and I don't think anything that we're seeing here will change that view. At the same time, they realise that in order to get inflation down, they need to reduce demand and they need to see a bit more slack in the employment market. But equally, they won't want the UK to go into too tough a recession and unemployment to rise substantially. So I think the balance between a mild recession, which allows inflation to fall down towards their estimates over the course of the next 9 to 12 months, without them having to hike rates much more aggressively, is not a bad outcome for them.
Strength in that jobs market is still very significant, as you made note of too, right?
Yeah, no, the jobs market is very strong, and that's partly a function, of course, of ageing demographics, shrinking workforces everywhere, and an immigration thing as well. But again, the bank will take some comfort from the fact that vacancy rates are rising. There's modest downturn in wage growth here. The participation rate in the labour force is improving. Immigration's quite strong. So again, I think the bank will take that into account and will look forward. And I think they'll take some comfort from the fact that the employment market does seem to soften, which is likely to take some pressure off wage growth over the next few months.
So still a massive drop down, you think, from here?
I think we'll see inflation fall quite sharply from here. The Bank of England expect it. I think it will happen. And we could even be looking at inflation back to 2.5%, 3%, sort of 9 to 12 months from now.